revenue-generating measure included in this week's federal budget is drawing criticism from Canadian entrepreneurs and investors. The government is increasing the rate of the capital gains tax from 50% to 67%. It estimates the increase will generate an additional $19 billion in revenue. Capital gains are the profits that businesses or individuals make from selling an asset like a stock or a second home.
Amid a federal budget already riddled with red ink and tax hikes, the Canadian government is set to increase the nation's capital gains taxes. This move, shrouded in controversy and speculation, has sent shockwaves through Canada's financial realm, igniting fear and uncertainty among investors and entrepreneurs alike. The Canadian capital gain tax is no ordinary tax hike. It's a looming catastrophe of epic proportions with devastating consequences for investors, entrepreneurs, and everyday citizens alike. The country's finance minister, Chrystia Freeland, recently delivered a federal budget that keeps the deficit capped at $40 billion, thanks to higher-than-expected government revenues and new taxes on certain capital gains. In Canada, the top 1% of income earners already pay more than 50% of all capital gains taxes, while the bottom 50% of earners contribute less than 5%. In other words, the proposed tax hike would disproportionately target the individuals and businesses most likely to invest in the Canadian economy, create jobs, and drive inflation. It's a classic case of biting the hand that feeds, a short-sighted gambit that could have devastating long-term consequences for the nation. A recent report by the C.D. Howe Institute warns that increasing the capital gains tax rate to 75% could reduce investment in Canada by as much as $7 billion per year, while costing the economy thousands of jobs annually. It's a stark reminder in the high-stakes game of global capital, even the slightest shift in the winds of taxation can send investors running for the hills, leaving Canadian businesses and workers to bear the brunt of the fallout. The decision to increase capital gains taxes comes at a time when Canada can ill afford to alienate its most critical economic drivers, and Canadians are grappling with the grim reality of diminished opportunities and vanishing prosperity. With investment opportunities dwindling and job creation grinding to a halt, the future of the Canadian economy hangs precariously in the balance. Moreover, the timing of this tax hike couldn't be worse. With citizens still reeling from the devastating economic impact of a stagnated economy, the last thing they want is another obstacle hindering their ability to bounce back. Yet that's precisely what they face as they confront the prospect of higher taxes and dwindling investment. In this video, we will delve deep into the heart of the matter, unraveling the complexities of this significant fiscal policy shift, what it means for an average Canadian, and how it looks to affect the economic landscape of the Great White North. According to Budget 2024, the Canadian federal government introduced an increase, but only for certain capital gains. For individuals with a capital gain of more than $250,000, 66.67% of that gain is taxable. This inclusion rate change comes into effect on June 25, 2024. But what exactly is a capital gains tax, and why has it become such a hot-button issue in recent months? Put simply, a capital gains tax is a levy imposed on the profits earned from the sale of an asset, whether that be a stock, a bond, a piece of real estate, or any other investment that has appreciated in value over time. Under current Canadian law, only 50% of capital gains are subject to taxation, but there is growing pressure from some quarters to increase that ratio to 75% or even 100% in order to help the government raise more revenue, pay down its ballooning debt, and amplify the Canadian progressive economic pattern. On the surface, this may seem like a sensible enough idea. After all, with the federal deficit reaching a ridiculous $381.6 billion in the 2020-21 fiscal year, $90.2 billion for the fiscal year ended March 31, 2022, and the national debt rapidly approaching $1.2 trillion, it's clear that the government needs to find ways to boost its revenues and get its fiscal house in order. And what better way to do that than by tapping into the vast wealth generated in recent years by the country's booming stock markets and red-hot housing sector? But as with so many things in life, the reality is far more complicated than the rhetoric would suggest. And when you dig beneath the surface of the capital gains tax debate, what you find behind is a web of competing interests, unintended consequences, and perverse incentives that could end up doing more harm than good to the very people and businesses the policy is ostensibly designed to help. To understand why, it's important to look at who pays capital gains taxes in Canada. According to data from the Canada Revenue Agency, the vast majority of capital gains taxes are paid by a relatively small number of high-income individuals and businesses. In 2017, for example, the top 1% of income earners in Canada accounted for more than 50% of all capital gains taxes paid, while the bottom 50% of earners paid less than 5% of the total. This concentration of capital gains taxes among the wealthy has led some to argue that increasing the tax rate would be a progressive move that would help reduce inequality and ensure that the country's most privileged citizens are paying their fair share. For one thing, it's important to recognize that not all capital gains are created equal. While some investors may indeed be reaping windfall profits from the sale of stocks or real estate, others may be simply trying to save for retirement, fund their children's education, or invest in the growth of their small business. And for these individuals and families, an increase in the capital gains tax rate could have a devastating impact on their financial security and well-being. The same is true for homeowners who have seen the value of their property skyrocket in recent years, thanks in part to the red-hot housing markets in cities like Toronto and Vancouver. For many of these individuals and families, their home is by far their biggest asset, and they may be counting on the profits from its eventual sale to help fund their retirement, pay for their children's education, or achieve other critical financial goals. But if the capital gains tax rate on real estate is increased, they too could see a significant portion of that wealth evaporate, leaving them far less than they had bargained for. Indeed, there is already evidence that the mere threat of a capital gains tax increase is having a chilling effect on the housing market in some parts of the country. In recent months, for sale signs have become an increasingly common sight in neighborhoods across Canada. Following this new policy, it's only going to get worse as homeowners will undoubtedly rush to cash out before any potential tax changes take effect. According to data from the Canada Real Estate Association, national home sales fell by 2.9% in January 2022 compared to the previous month, while new listings dropped by 10.8% over the same year, a clear sign that many potential sellers are holding off on putting their properties on the market in the hopes of avoiding a more enormous tax bill down the road. Oftentimes, capital gains are taxed on a realization basis, which means the investor does not incur capital gains taxes until the asset is sold. According to empirical evidence, this creates a lock-in effect where investors are incentivized to keep their capital invested in a particular asset when they might otherwise sell. For instance, investors may delay selling capital assets because they anticipate a change in government and reversal back to the previous inclusion rate. This means the Trudeau government is likely overestimating the potential revenue gains from its capital gains tax hike, given that individual investors will adjust the timing of their asset sales in response to the tax hike. This lock-in effect creates a drag on economic growth as it incentivizes investors to refrain from selling their assets when they otherwise might, preventing capital from being deployed to its most productive use and, therefore, reducing growth. And Canada's growth prospects and investment climate have both been in decline. Canada currently faces the lowest growth prospects among all OECD countries in terms of GDP per person. Further, between 2014 and 2021, business investment adjusted for inflation in Canada declined by $43.7 billion. Hiking taxes on capital will make both pressing issues worse. But it's not just homeowners and small business owners who stand to lose out from increased capital gains tax rates. The policy could also have a devastating impact on the broader economy by discouraging investment, stifling innovation, and driving job creators and entrepreneurs to seek out more favorable tax environments elsewhere. According to a recent report by the C.D. Howe Institute, increasing the capital gains tax rate to 75% could reduce investment in Canada by as much as $7 billion per year, costing the economy up to 9,000 jobs annually. The report's authors warn that such a move could make Canada a less attractive destination for foreign investment, while also encouraging wealthy Canadians to shift their assets offshore or into tax shelters, a phenomenon known as capital flight. Indeed, there is already evidence that this is happening as high net worth individuals and businesses seek out more favorable tax environments in countries like the United States, which currently taxes capital gains at a rate of just 20%. According to a recent study by the London-based consulting firm Henley & Partners, some Canadian millionaires say they are considering relocating to another country, with many citing high taxes and over-regulation as crucial factors in their decision. This is a deeply troubling trend, one that could have far-reaching consequences for the Canadian economy and society as a whole. After all, it is precisely these high-net-worth individuals and businesses that are responsible for creating the vast majority of jobs, driving innovation and economic growth, and generating the tax revenues that fund our social programs and public services. If even a tiny fraction of them were to leave the country or simply shift their investments elsewhere, the impact on employment, wages, and government revenues could be devastating. But the risks of a capital gains tax increase go beyond just the potential for capital flight and job losses. There's also a genuine danger that such a policy could end up exacerbating the very problems it is meant to solve, namely the affordability crisis and the growing inequality between the rich and the poor. To understand why, it's important to recognize that one of the key drivers of the affordability crisis in Canada is a lack of supply, particularly when it comes to housing. In cities like Toronto and Vancouver, the demand for homes has far outstripped the available supply, leading to skyrocketing prices and a growing number of Canadians being priced out of the market altogether. If the capital gains tax rate is increased, particularly on real estate, it could worsen this problem by discouraging investment in new housing development and renovation. After all, if investors and developers know that they will be hit with a hefty tax bill when they eventually sell their properties, they may be less likely to take on the risk and expense of building new homes or improving existing ones, a trend that could lead to even tighter supply and higher prices down the road. Another facet of this quagmire the budget ostensibly neglected is the impact this policy would have on wealth inheritance and distribution. A seismic quantity of wealth to the tune of $1 trillion is set to move from Canadian baby boomers to their Gen X and millennial heirs between now and 2026. It's predicted to be the largest generational transfer of wealth in Canadian history, accelerated partly by the increasing popularity of giving while living, with potentially significant downstream effects on the country's economic landscape. However, the proposed changes to the capital gains tax could throw a wrench into this delicate process, creating unintended consequences that could ripple through the economy for years to come. Under the current system, when a person passes away, their assets are deemed to be disposed of at fair market value, triggering a capital gains tax on any appreciation in value. This can create a significant tax liability for the estate, often deferred or avoided through careful planning and using certain tax provisions. But if the capital gains tax rate is increased as the government has proposed, it could make this process much more complex and costly for families seeking to transfer wealth to the next generation. The higher tax rate could force many estates to liquidate assets to pay the tax bill, potentially flooding the market with a sudden influx of stocks, real estate, and other investments. This could have a destabilizing effect on asset prices and market conditions, creating uncertainty and volatility at a time when the economy is already on shaky ground. And yet, despite all of this, the powers that be seem hell-bent on pushing forward with this reckless gambit, blind to the dangers that lie ahead. At a time when Canada badly needs to improve the incentives to invest, the Trudeau government's 2024 budget has introduced a damaging tax hike. In delivering the budget, Finance Minister Chrystia Freeland said, "Canada, a growing country, needs to make investments in our country and in Canadians right now. Individuals and businesses across the country likely agree on the importance of investment. Hiking capital gains taxes will achieve the exact opposite effect." If you like this video, hit the like button and help us spread the word. And don't forget to subscribe to get notifications on our latest news and analysis. In the meantime, check out one of these videos here to learn more. Thanks for watching.